Okay, well, welcome. I'm Matt Price of the Price Group. Still have a number of people, it looks like, trickling in, but Randy is out. He had a chiropractor, he had something this afternoon. But we'll be looking at our monthly market update. Just as a reminder, we want to keep this 10, maybe 20 minutes long, give a brief highlight. We'll be looking at kind of the year in review today. Over the past few months, this has prompted questions from a few clients. We love that. So if you don't have a question here to type, shoot us an email, give us a call. We're also recording this and we'll send it out here in the next week or so once we get that up on our website. So let's jump in. Looks like on the call, a couple dozen people, most of which are familiar faces, but for a few of you who may not be as familiar, I'm Matt Price, Randy Price. He'll try to tell you he is my older brother. He's actually my father. We follow a fiduciary standard for our clients. We have a retirement niche. Over 80% of our clients are retired. We think that's becoming more and more important in this type of market and environment that we are investing in. We have a team of 5, soon to be 6. We'll be sending out a client email this next fall. We're planning to hire someone March or April. So we think that is good news. Both of us, Randy and I, and Maddie Kearns as well, certified financial planners. Randy has a number of designations, awards that he has won, as you can see. Our firm, Steward Partners, based off the biblical definition of stewardship. Raymond James is one of our 2 custodians. Custodian, just a term where client assets are held. The other is Pershing. Most all of our clients are at Raymond James. They've been a real good partner for us. Something a client said a month ago, he said, "Hey, I'd love for you to look back at the year and tell me where you were right and tell me where you were wrong." And I thought, you know what, that's a good idea. We should do it here for this monthly market update in December. So what we're looking at is these were our themes. For those of you that tuned in to our first webinar of the year, our themes for 2023 back in January. These were our 9 themes for investing. And looking here, we got a few of them right. We got a few of them wrong. We had said a recession toward the back end of 2023. That has not happened yet. We had said for number 2 and 3, we thought the Federal Reserve would stop increasing interest rates kind of in the latter part of 2023. So we got that part right. Inflation, we thought, would start to roll over. It's actually moved a lot lower, a lot quicker than we would have thought. We had said we think there's a reduced volatility. That one was pretty easy. 2022 was a high year of volatility, so that was an easy one to add to the list. Globalization is not dead. You remember this time last year, there was still a lot of talk of the supply chain disruption and parts not being able to get in, and chips were not there for cars to be manufactured. You've seen more of a normalization in 2023, which is a good thing, pretty much across the board. We thought bonds were back. We were kind of wrong on this one for a while. Bonds were really anemic or break even really through September, maybe October, but the last few months you've really seen bonds come back into action. We have a slide to talk about that in more detail. The biggest part of that is over the last few months you've just seen interest rates move lower as well. We thought there were brighter days ahead for stocks. Stock market, we'll discuss in a minute, has had a good year. Fundamentals matter. This one, I'd say we were kind of right, but kind of wrong. The top performing stocks have been, you maybe read about it, called the Magnificent Seven. Facebook, Apple, Microsoft, Netflix, some of the high-flying tech stocks, and one could argue they don't have the best fundamentals there. And then don't be a sheep, more of a, not investing related, but just let's not think necessarily the way everyone else is, because typically the herd is wrong. And the herd this time last year was thinking 2023 might be another rough year to be a stock investor. So I think that was fun. I think we're going to start doing this at least on an annual basis. We'll have our themes for 2024 next month. But it's good to not only hold us accountable, but kind of to look back and see what can we learn from the last 12 months. So here's kind of an overview of how markets have performed. This was as of last Friday. Stocks have, like we said, had a good year. The 60-40 portfolio, 60% stock, 40% bond, has also had a good year. Cash still, you can see almost that 5% rate of return, a good year. And bonds, you know, the overall bond market up 4-ish% round numbers. So it's been a good year to be an investor, whether that's a stock investor, bond investor, even a cash investor for this calendar year. And part of that, the GDP, the gross domestic product, grew more than a lot of people expected. You can see here, this was one of the larger upward revisions dating back over the last 20 to 30 years, which is hard to believe. But the economy really has been resilient. About 2/3 of the economy are on the back of consumers, and that's really the story of the year. Consumers have kept spending. So there were reports early on this year that the consumer was going to really tighten their belt and cut back on spending. Thus far, that has not been the case. The glass is half empty way to look at that would be you're starting to see some auto loan delinquencies, credit card bills that are not being paid are on the rise. So this is not necessarily all good news, but the consumer really has carried the economy across the proverbial goal line for calendar year 2023. Inflation, there was a sharp decrease, which was a good thing. This time last year, or maybe really last fall, inflation peaked around, depending on how you measure it and which government index you're looking at, peaked 7-8-ish%, and it's been going lower ever since. So I read an article earlier this week. We should see egg prices actually move higher here over the next few months. Just there was another big bird flu that's going to reduce the amount of eggs. But for the most part, food has moved lower. Shelter, apartment rents are actually going to be moving lower. And then once mortgage payments, we've seen mortgage, the 30-year kind of borrowing rate peaked about a month ago and has started to trickle lower. Once some more of that gets in the system, what we look at, we call it the shelter cost, should also start to wade lower because of those metrics. But it's kind of maybe a football analogy with the NFL playoffs coming up. It's pretty easy to get the ball into the red zones. It's a lot harder to score a touchdown. The first kind of wave of having inflation move lower is typically, when we look back at history, easy, quote unquote, and it's the last kind of piece that is typically the hardest. So we think inflation, you can call it 3, maybe 3.5%. We think getting it down to the Federal Reserve's goal, what they've stated, around 2%, we think that's going to be a much harder progression going into 2024 than how easily inflation moved lower in 23. But lower inflation, we think, is something to be thankful for. And that's honestly one of the big reasons we did see stocks move higher this year, is the market was forecasting that rates would move lower, interest rates that is, and also inflation being kind of the skeleton of why rates have moved lower. Bonds avoid a third negative year. And so looking back to 1976, there has never been 3 consecutive years of negative returns for bonds. So you were in good company if you thought bonds would be higher. Like I said earlier, there was a little bit of some trepidation maybe in August, September, when bonds were still for the year just about break even. But like I said, the last few months have been positive just with interest rates moving forward. We think this sets up really well for another year of good performance for bonds, fixed income, moving into 24. We'll cover that in a lot more detail next month on our monthly update, which, by the way, will be a little more beefed up than this. So we try to do 3 or 4 really in-depth webinars, and then the other 8 or 9, 10 of them are a little more light on the information. Money markets hit a record high, and you can see a big part of why this was back just, it feels like a long time ago, but it really was only 7, 8 months ago. The banking crisis with First Republic, Silicon Valley Bank, you saw a lot of money last spring leave banks and move into money markets. The legislation back from 2009 called the Dodd-Frank Act made money market funds a lot more safe. I mean, money market funds are essentially just a really, really short bond that's 30 days or shorter. So all the bonds inside of there are maturing typically in the next month or so. You saw rates rise. The Federal Reserve continued to raise rates through the summer months, and that made money market yields move higher. So right now, money market is kind of warm and cuddly, and it's easy to be really excited about the yields. Our thought over the next 12 months, we think that the Federal Reserve actually is going to cut interest rates, which means that the yields on the money market are going to move lower. So for a lot of clients, we've been starting to lock in some of the yields. Maybe instead of just owning money market that can reduce its income overnight, if the Federal Reserve were to reduce interest rates, maybe we lock in a 1, 2, 3, 4-year bond where we can have that income guaranteed until that bond comes due. So right now, it has been a great place to hang out. We're starting, and I've already done it for a lot of clients, reduce that money market and lock it into some bonds that are more long-term. The not so fun part of this presentation, the federal debt has hit a record high. That's not really new news to anyone. Thought it helpful that the graph, the chart here on the left, shows the debt held by the public versus the intra-governmental debt. Some people would argue that if there was an issue, the one branch of government would just forgive the other branch. I don't know how true or not true that is, but regardless, it's still, the number's too high. You're starting to see both sides of the aisle agree on this. It's been an issue where it's just been kicked the can down the road. We're of the opinion that the can is gonna kind of pop or blow up at some point, and there needs to be action taken sooner rather than later. So this is a concern for us over the medium term. We used to think this is something way out in the future. It has not really affected the markets to this point, but we do think this is something that is the clock is ticking, is maybe another way to say that. And one other slide on the budget. You know, we're spending more money than revenues that are brought in from taxes that you pay. If you wanted to spend this in a positive manner, you say, well, the deficits are a lot lower than they were in 2020, 2021. That is true, but the chart here on the right, the annual federal deficit, our deficit this past year is still, it is projected to be more than it was in 2008, 2009, and even 2010, coming out of the financial crisis that we all remember. So we do think changes need to be made, just structurally spending less, but no one from DC has called and asked for Randy's, or my opinion for that matter. So we're right on time, 15 minutes in. Like I said, if there are any questions, please reach out, let us know. Happy to go into investment strategies in more detail. And we're humbled and thankful for another year of being able to serve clients. It's something we don't take lightly, and we look forward to a prosperous 2024. And we don't talk to you, Merry Christmas, Happy New Year, and wanted to say thank you once again for being a client of the Price Group. So wish you all the best, and look forward to catching up soon. Thanks.